Thank you very much, Marty. So good morning, ladies and gentlemen. MI2 Partner was formed 12 years ago. It was actually formed when a very large hedge fund client of mine, I was on the sell side, approached me and wrote me a check and said, look, I can't do enough business with your firm to pay for your thoughts. Why don't you go and set up your own business? And that's exactly what we did. And we grew the business over the last 12 years with a range of clients, from sovereign wealth funds to some family offices to a lot of hedge fund clients and real money accounts. And the thing that we do at MI2 is we like to start off with a macro view. It's the basis of anchoring our views and then coming up with concrete ideas and trades around that and strategies around that. It's no point, I'm just not interested in pontificating about where I think the economy is going if I can't make money out of that. I think that's a pointless exercise. So I want to talk to you today about a view that we have of the world, which actually I first rolled out at a conference, a tiny little conference, 20 people, but $3.5 trillion of AUM in the room, which I gave on the 25th of April last year. And it was a pretty punchy call at the time. I still think this thing has an awfully long way to go. I don't think people realize the implications of it. Needless to say, I'm getting invited back to the conference again, this little conference, next week. So let's run these things through. And I called this presentation, and I'll just put it up on the screen so you can see it. Hopefully you can. The world's biggest carry trade. So let me explain what I mean by that. So if you look at this chart here, you've got the US current account in pink, and you've got the MSCI US equity index in white. And what we're really talking about here, ladies and gentlemen, is a self-reinforcing cycle between US asset prices and the US economy, whereby the relationship becomes truly reflects the Soros-esque way of using that. So it's self-reinforcing. Now, in fairness, this factor, this phenomena is not unique to the US. We had a very similar cycle in Japan post the Plaza Accord, where we saw the yen rise 50% against the dollar, and that suck in money and fuel the Nikkei bubble. We also, on a much smaller scale, had a similar dynamic in Australia post the GFC from 2009 through 2011. But given that the dollar is the reserve currency, the US is uniquely prone to these events. Indeed, despite slight variations between these, there's very similar dynamics we saw in the dot-com period, which we've highlighted here with this yellow band, and also to some extent during the pre the GFC, although the flow into assets was very different there. It wasn't equities, it was primarily housing-related debt. So let's run through how this works. So, and how we've got here. So post 2011, as the dollar started to rise, there is a natural proclivity of foreigners to hold dollars. And as the dollar rises, that becomes self-reinforcing. They then look to buy assets. And in the last decade, it was primarily US stocks. After all, we've even got central banks going into that game, and US corporate debt, which in turn got plowed back to a large extent into the US equity market. That rising stock market not only attracts even more money from its relative outperformance, but the ensuing wealth effect leads to a booming economy, which forces the Fed to raise rates, making the dollar even more attractive, and also drives up the current account deficit, which has to be funded by yet more foreign inflows. Bingo. You've got this reflexive, self-reinforcing, virtuous cycle that looks utterly impenetrable. But the very fact is that by its definition, ladies and gentlemen, this is a stable, unstable equilibrium dependent on a strong US economy to support the current account deficit. If the current account deficit drops, we do not need that foreign money and the money goes home. Continued US equity outperformance, because that's where foreigners have got their money. And if it starts to underperform, the money goes home. And thirdly, ongoing dollar strength, because definitionally to fund that current account deficit, the money that foreigners have invested is un-FX hedged. So this is the proverbial three-legged stool. So let's look at those three metrics and see where we are in the cycle. So the first question is, let's look at the economy. Can we avoid a recession and the subsequent contraction of the current account deficit, which would reduce the need for so much foreign capital that's already invested in our markets? Well, when we look at the economy, and particularly the credit cycle, what you can see here is C&I loan demand in green, and the banks tightening credit in red, C&I, and you can see that we've already seen a material tightening. And interestingly enough, demand is also following. Now, the level of tightening is already on par with the recessions of 90 to 91 and 2001 to 2002. And this is obviously pre SVB, because we don't have the latest data on this. But this already suggests a pretty decent sized recession, because it's going to hit everything, ladies and gentlemen, right? This is C&I loans, but it is going to hit CapEx, which is going to drop severely, we believe. And remember, the CapEx cycle and the inventory cycle are two of the most vicious economic cycles out there. It is going to hit the consumer. We've already seen consumer credit drop from over 40 billion a month to around 15. So it's running at roughly a third of its current level. And when we look at SVB, we don't have much data, right? We're going to get the next senior loan officer survey on the, I think it's the 8th of May. The Fed, interestingly, will have this heading into their meeting. So if they were to surprise everyone and not hike, or come out with an extraordinary dovish hike, it could very well be a tell that they've seen this data and it doesn't look very good. The only data that we have, official data that we have, that gives you an indication is here in pink. And this is the Dallas Fed loan survey. I'm not a huge fan because we don't have a lot of background back data, but you can see it is sitting now at levels that were commensurate almost with the GFC, and certainly as bad as COVID. So at least as a sense of direction, this is not a very bullish sign. Now, the bulls will say, don't worry, Julian, because the consumer is in pretty rude health, right? And in nominal terms, that's actually true. But the problem is, in real terms, that's not. So if you look here, you can see real disposable income, and you can look at it versus the trend, and you look at that divergence. And what we're seeing is the largest drawdown on real disposable income that we have seen in almost the last 60 years. Why is that? Because American corporations have been extraordinarily good at sticking their hand into your pocket and taking every red cent out of it via price increases. But the problem is while that's fine for corporate earnings, what counts in the real economy is not nominal activity, but real activity. Because we produce one real widget, not one widget times 10% price increase. We employ one person. Okay. And if the volume of activity starts to fall, you are going to have an economic problem. And indeed, we think we have, because when you look at things like real levels of inventories, okay, we have absolutely over ordered, leaving retailers in particular in the US with inventories, when you adjust them for inflation, which is the highest that we've seen in the last 30 years. So these have to get adjusted down. And as that real disposable income falls, the ability of the consumer to buy those inventories is falling. The net result is you are looking at an inventory cycle in the manufacturing sector. So you can see it here. Customer inventories have surged. Typically, when customer inventories clip the manufacturing ISM headline from below, you are in a recession, unless, which was the case in 2016, the Fed punts the cycle. And indeed, S&P Manufacturing in their recent comments said exactly the same thing. The worry is that new order inflows continues to fall sharply as many companies report disappointing sales linked in part to sustained trend towards cost-saving, inventory reduction, and low level of confidence at their customers, both at home and abroad. Therefore, when you look at manufacturing, you are already at recessionary levels. So if you look at new orders historically, once you are below 47.2, you are in recessionary territory. And unless the Fed punts the cycle, where I've highlighted here that they've done it in the past, the end result is almost certainly a recession. So we have a credit crunch coming and a manufacturing inventory-led recession coming. Now, the good news in theory is even if we get credit cycle, CapEx, and an inventory cycle, which is what we got in 2001, 2002, we could still get that very shallow recession, which is what we got back then. The problem there is as you can see here, post 2001, 2002, even though we went into a very shallow recession, what happened is that housing started to accelerate and kind of save the day. It stopped that second round effect. And the problem is, ladies and gentlemen, we've already had our housing surge. We've already had a 43% rise in the number of homes under construction since the lows of COVID. We're already producing housing at the highest level that we have in 50 years. And these are under construction. They have yet to hit the market. Okay? And unfortunately, they are going to be hitting a market where sales are already falling. Okay? So if you look here in white, you've got the ratio of homes under construction versus sales. It has spiked to historic highs. The rate of change is unlike anything that we have seen historically, and spikes of this level are always associated with a recession. And indeed, if we just take something simplistic, advance it by 6 months, which is just our housing activity model, we are definitively going into recessionary territory. And it does not look like to me that this is a 2001, 2002 very benign recession, because you note on a year-on-year basis, actually, we didn't even get negative GDP growth back then. We did on a quarter-on-quarter. That's why it's officially recorded as a recession, but not on the year-on-year basis. Now, that brings us to the big one, employment, right? The last man standing. Now, when we look at the labor market, we like to look at this series called aggregate weekly payrolls, because it is exactly what the name suggests. It's an aggregation, essentially, a broad snapshot of what is going on in the labor market, because it aggregates the number of people working, how many hours they are working, and how much they earn an hour. So essentially, view this as sort of pre-tax take-home pay for the US economy. And as you can see, it is steadily declining. It is highly correlated to nominal GDP, unsurprisingly, but it is still very high. Now, a lot of people have said, well, look, you know, inflation is falling. It's going to be all right, that the Fed is going to be able to back off. But herein lies the rub. And this is why it's been our view all along that the Fed, despite what they've been saying in front of the politicians and playing their kabuki theater, actually have always intended to break the back of the labor market. They literally have no choice, because envisage a scenario, right, which the equity bulls would salivate over, where we wake up tomorrow, nominal GDP is still 7% and inflation has fallen to 0. Hurrah, right? Well, not unfortunately in the current environment, because if nominal GDP is still 7 and inflation is 0, that means real growth is 7. And you can't have real growth of 7% when you have trend growth of 1.75 and an unemployment of 3.5% without stoking inflation. So the bottom line is the Fed was always going to break the back of this labor market. They had to break the back of this labor market. And the good news is we are about to get there, because employment, ladies and gentlemen, is simply a momentum game. If you look at this chart here, this is total unemployment in the United States, the unemployment rate, sorry, you will see that it looks like a mountain range where, you know, looks like Colorado, where my firm is based. Okay, very sharp peaks and low, steady valleys. And either you are rising or you are essentially falling. You spend very little time going sideways, tracking along the bottom. And once you start to lose momentum, the trend is typically higher. By the way, once you pretty much cross that 12-month moving average of the unemployment rate, which is currently 3.55%, so 0.5% above where we, so 0.5% of 0.5% where we are above now, you are typically going to head into recession because the momentum picks up, unless, again, the Fed punts the cycle, which you can see in blue, which I do not believe they're going to do. And indeed, our models are already suggesting that we are starting to see a loss of momentum. Another way you can look at this, for example, is claims data. This claims data shows very, very clearly that once claims start to rise more than 10% year over year, and currently this particular metric is rising at almost 14, you are either in a recession or 1 quarter away from a recession. By the way, the base effects on this are going to kick in extraordinarily hard, and this thing will be rising at 50 to 60% over the next couple of months. So there's no question in my mind that we are either in the recession right here, right now, or we are heading into the recession next quarter. And it's going to be a pretty unpleasant recession. We are going to see in the second half of the year into early 24, unemployment rise to around 6.5% at least. I say at least because some of our models are suggesting we could go all the way to 7%. Therefore, given that I'm a Brit and I like James Bond, to use a James Bond scene, if you remember, any of you who saw the movie GoldenEye, you'll remember there was an annoying Russian programmer called Boris, who's played by Alan Cummings, who thought that he was the bee's knees. And, you know, at the end of the movie, in a classic Bond type way, there's a big explosion. He survives, he looks down, he realizes he's alive, and he stands up and he screams, "I am invincible," only to be caught out by the exploding liquid nitrogen tanks behind him and turned into a popsicle. And I think this sense that we had at the beginning of this year of this invincibility, this no landing, this soft landing, is simply forgetting, ladies and gentlemen, as Boris did, explosions work with a lag. And just because you survive the initial 450 basis points of rate hikes and you look around and you go, "Oh my goodness, look, the equity market's doing well. Oh my goodness, consumers are still spending," it doesn't mean that the liquid nitrogen tanks aren't going to burst. I'm afraid they are, and they are coming in the form of a pretty ugly but standard kind of recession, a recession with a housing activity contraction, construction in particular, an inventory cycle, and a pretty nasty credit cycle, the magnitude of which we do not fully understand, but was already bad enough pre that. So bottom line, okay, we have all the conditions for that slowdown, for that contraction in the current account deficit, which will negate our need for all that foreign money. So let's look at now the next leg, the equity market. Can US equities continue to outperform in that environment so that foreigners are still keeping their money locked up here in the US, despite maybe an economic slowdown? Well, the first thing to remember is US stocks remain extraordinarily expensive. Okay, if you look at the NYC, so the broad US equity market versus nominal GDP, we hit the highest ratio that we've had in almost 60 years. And thus far, with just a little over a 10% correction in the NYC from highs, this is an incredibly small drop, right? Even in the mid-60s, we saw a 22% drop in the NYC, having hit these extremes, and the average is around 30. So arguably, we're only a third of the way there. Now, the big advantage is we have seen some of the correction, but here's the problem, ladies and gentlemen. At the highs, the US equity market, which you can see here, white, versus its peers in the rest of the world in orange, hit a statistically impossible 5 standard deviations away from the mean. It's never done it before, ever. And now it is still sitting at a statistically improbable 3 standard deviations from the mean. I do not take bets where the odds are over 99.7% against me. Okay. Now, the good news is stocks continue to follow the equity market. the liquidity metrics, right? So there's liquidity metrics we all know, where you take the Fed's balance sheet, you take the reverse repo out, you take the Treasury General account away, and you get this liquidity metric. And the equity market continues to follow this, right? This is not a market that's driven by fundamentals. This is a market that is driven simply by liquidity. But irrespective of that, the bad news is that US stocks, despite their holding up because of the Fed's reversal of liquidity post SVB, is that they are starting to underperform their peers. So if you look at the S&P versus Euro stocks, foreign investors, you can see, have done extraordinarily well having their money in the US, right? This ratio has gone from 4 to it's almost to 10 at its almost highs over the last decade, but it is now breaking down. Since the third quarter of last year, foreigners would have been better keeping their money at home, and that applies not just to Europeans, which you can see here, but also to the rest of the world. And even more perturbing is the fact that they seem to be waking up to that risk. This is the price action of the S&P when you parse it for the movements in the cash hours in US hours, okay, in blue, and then the overnight session to get a sense of what foreigners are doing. And foreigners since January have been steadily selling. So I would maintain, ladies and gentlemen, that not only do we have an economy now, which no longer needs that foreign money, but foreigners are starting to react to that, and US stocks are underperforming, which brings us to the final linchpin, the dollar. Because, as I said earlier, foreigners have bought US assets to fund this large current account deficit in this reflexive cycle. And those purchases have to be un-FX hedged. So essentially, they are running a massive naked dollar exposure. Okay. Now, this has worked brilliantly, as you can see here in a chart of the euro, since 2008. Right, the euro has dropped from 160 all the way down to par. But dynamics are starting to change. Now, I'm watching to see if we can get a monthly close above 109.35, which would suggest a move up to the top of this band around 117. But more importantly than that, ladies and gentlemen, there is a rule that goes back to 1972, since the start of Bretton Woods, and that is that 80% of the time, the highs and lows of the year in the euro are made in the first 3 months of the year. Now, the range that we have is 110.33 on the top side and 104.85 on the downside. So the bottom line is, if we get a monthly close, another monthly close above 110.33, the odds are 80% in your favor that this is a dollar down year. And if the capital starts to go into reverse, it could move a long, long way. So here you've got a trade-based model for the euro. And this is the slow moving components of that drive currencies. And you can see how central banks during that bout of QE, LTRO, Fed QE, ECB QE diverged the currency from the model, but how ultimately it always kept going back to that underlying trend. Now, it hasn't gone back to that yet because that money that Europeans have earned from the trade has been recycled via the capital account back into the US, into this US equity market. But if the currency starts to go in a market where they'd already be better off to be at home, you could get a closing of this gap pretty significantly and pretty quickly. And the implications, ladies and gentlemen, are really, really important, because it's really significant to understand what that dollar in that reflexive cycle does to the performance, how that money, it sucks in money that turbocharges US assets. And you can see it here, literally, ladies and gents, since 2011, US stocks have been the only game in town. The S&P was up over 250%, and everything else was basically down. I mean, for all the talk about, commodities being rampant, they're still down 33% from those levels. And this is all linked to the dollar. And within the US equity market, we know which sectors have massively outperformed. It's been tech, healthcare, consumer discretionary. Energy is barely positive, despite the run-up. Mining and metal is still absolutely negative. Right? We have sucked in all this money, and it's turbocharged these things. Now, secondly, what could happen if the dollar starts to fall? Well, interestingly, history gives us a clue. From 2002 to 2008, the dollar declined 35%. Now, I'm not, ladies and gentlemen, please don't get me wrong, talking about the demise of the reserve currency, or, I'm not putting on my tinfoil hat and talking that the Chinese are taking over everything. I am just literally suggesting we could have a standard dollar decline. We've seen 3 major dollar declines since 1972, and I think this could be the 4th. And here's the interesting thing. In that dollar decline from 2002 to 2008, which were pretty good years in the US stocks massively underperformed their peers. And this is very generous because this is going from 2002. Because if I took it from the highs of the NASDAQ in 2000, US tech would be down way more than this. And in fact, if you look at the rotation within the sectors, you can see, versus the prior slide I just showed you, literally all the current winners would become the current losers. You are talking about a rotation in the equity market of truly biblical proportions, whereby the last will be first and the first will be last. And this is driven by flow. And this flow of this reflexive carry trade that we've had for a while. And frankly, in that environment, the thing that I really want to work is tangible assets. And here's gold versus the S&P. And the setup looks frighteningly similar to me to the way that it did in 2001, just before the US went into the recession, post the dot-com bubble, and the Fed was forced to ease. That's it. Thank you very much.
Don't go anywhere.
I'm not.
Don't go anywhere. We've got all the
Questions here. So questions from the audience here? Yeah, John?
So the interfering factor in your prediction will be the attitude of the Fed. Hello?
Just speaking to the microphone.
Hello? Yeah. So the interfering factor is the Fed, right? I mean, if the Fed is discerning a massive slowdown, as you're predicting, both in the economy and also a threat of a massive revaluation of the stock market, which is a major factor in the economy. It's a store of wealth. And the Fed decides, okay, we've had enough. We're going to either stop or actually decrease interest rates.
Yeah.
Could that, in fact, moderate your outlook?
Not really, because that's what they did in 2000. We slipped into recession. If you remember the cycle of the dot-com bubble, it started in March of 2000 with the NASDAQ. The high on the S&P was in September of 2000, and the high on the Dow was in May of 2001, when we'd already started to enter a recession. So they started to cut rates, and as they started to cut rates, the dollar started to decline, because what they're doing is in itself, reflationary, which is good. It's just, and the US equity market started to rally. It's just underperformed its peers. And that's what we're talking about. Look, these ratios can correct in 2 ways, as we say. They can correct the nice way or the nasty way, right? So how do you get this sort of massive rotation between commodities and Europe and the US, et cetera, et cetera? Well, the nice way or the nasty way? The nasty way is everything drops, the US drops more. The nice way is the US just underperforms in a rallying market. But it just means from an asset allocation perspective, you're probably in the wrong thing. When I talk to, RIA friends and talk to them about how families are invested and people are invested, and I say, oh, so they've still got that sort of 35 overseas, 65 domestic, which is what they're supposed to have. And they're like, nah, it's probably more like 90-10. Oh, and in that 90, where are they invested? Tech, healthcare, consumer discretionary.
We have another question.
I have 2 points. So one is the markets have corrected really more significantly than you mentioned, where you talked about 10% on the NYSE. At its peak drawdown from the top, the NASDAQ was down about 35%. It's a little bit higher now. And the S&P down close to 25%. So just pointing that out. The question I have for you is, how in any way does it make sense, does Fed policy make any sense of wanting to increase unemployment in a scenario where there's already affordability gaps? I mean, wages haven't kept up with housing by any stretch of the imagination. How, they'll crash everything, not just the economy, housing. How does it make any sense to want to throw people out of work?
They have no choice. You cannot, as I showed you, if you do not slow that aggregate weekly payroll metric, you will not slow nominal GDP. This is not 2009 or 2011 where we've got 10% unemployment and you can run the economy at 7 nominal. You can't. You have 3.5% unemployment and trend growth, if you're lucky, is 1.75. That's what they intend to do. That's how you do it. You cannot make the omelet without breaking eggs. It's just the kabuki theater that is US politics will not allow the Fed to say what the Bank of England said. Oh, by the way, you're going to have the worst recession in the post-war period. They have to break it. If you look at their SEPs, right, their central forecasts, they are absolutely a fairy tale. They have a 1% rise in unemployment, which then tracks sideways for 3 years, which I just showed you on a chart, does not happen, and no recession. Well, that's never happened in post-war history. Anything above a 0.5% rise in unemployment has always given you a recession.
It's interesting, Julian. So just a couple of questions. That you said there's going to be too much inventory. I mean, I think I was in Florida last week and I saw that they're offering deals on auto sales these days in terms of rates are going down to 0, right? Do you know anything, thoughts on the auto market? Is it a,
yeah, I mean, I look at
the same?
No, I mean, look, it's selective. I showed you retail, right? There are obviously areas where there are not that, but in general, broadly, Marty, we over-ordered, right? We moved from a just-in-time inventory cycle, which, by the way, was a major factor in lowering the volatility of the underlying economic cycle and what was referred to as the Great Moderation, in other words, post-1985, to a just-in-case. And we over-ordered, and now we're paying the price that we're sitting on this large inventory, including houses under construction, which is falling into a market where, sure, sales in nominal terms look solid, right? Procter & Gamble last quarter, revenue up 7%. How did they do it? Well, they raised prices 10, which means that volumes were down 3. Okay, well, that's fine on a singular basis, but when you distribute that 3 across every single company, that's 3% less units of production. That's 3% less people employed.
Got it. So you talked about tangible assets. You talked about gold. Yep. Is silver in the same boat? And any thoughts on collectibles? I mean, it sounds like you're not positive on real estate.
No, I mean, look, real estate should be fine at some point, right? It just takes time. To the earlier question, right? Wages have to at some point play catch up, right? Affordability is the big fundamental problem that we've got in really kicking off activity from a housing perspective. Personally, we've been buying gold and silver. We got our clients into it back in November. We're going out into gold miners. We're looking at various other things like that. We are a macro shop, so we don't delve into all the commodity space on an individual basis, but I think there are plenty of opportunities there. looking selectively at emerging markets. Particularly, I think one's got to be very careful about which emerging markets. I think you've got to, as US investors or European investors, you've got to think about which emerging markets you're going to be allowed to own, not maybe want to own, right? Because we've been writing since 2018 that we were going to see this bifurcation and return to a Cold War, and that's indeed what we are seeing. I think there's many sectors in the US which are going to be very attractive, right? You don't really need to leave the US equity market per se, if I'm right, that we're going to get this major sectoral rotation. There's plenty of opportunities here in the US in a week that will benefit from a weak dollar.
You're going to make some people really happy who have been investing in energy, that's for sure. Any thoughts on intangible assets?
Not really.
Intellectual property, things like that?
Not really my thing, Marty, right? A little bit too micro for me, mate.
Any thoughts on private credit, things like that?
Look, credit to me, I think, look, there are going to be some opportunities, there's going to be some real opportunities. I think the biggest problem that I've got with credit right here, right now, is while yields are attractive, so if you look at high yield, 9.5 towards 10%, that is not actually reflecting the underlying risk in the economy yet. When we model out those scenarios, high yield should be close to 15 to 16% in terms of yield. And I think what's happening is people are seeing 10%. They're so used to getting such paltry returns over the last decade that looks really sexy. And they're actually not factoring in the true economic risk, which would put those yields, as I said, at 15 to 16.
Any thoughts on foreign debt contagion? I mean, if they're pulling back on dollars, how's that affect, all this dollar debt that's been written in Latin America, Africa, et cetera?
So look, if the dollar starts to fall, that's great for those guys, right? I think people forget that there's a lot of talk about, this sort of milkshake theory. Oh, everyone's borrowed all these dollars overseas. This is a big problem. Well, it is when the dollar's strong, but we're talking about the dollar being weak. And by the way, definitionally, while yes, people have borrowed in dollars, definitionally, because we are the reserve currency and we run the current account deficit, that's part of the deal of being the reserve currency. There's more foreign money invested here than dollars borrowed overseas. There's about 12 to 13 trillion dollars worth of overseas borrowing. Many of that is from companies or governments who have dollar income stream. Okay. There's $23 trillion worth of money invested in short-term tangible assets here in the US.
And any other questions here? I have a comment and then, okay, question, 1 second.
Yeah.
Historically, and I'm going to give an example of Colombia that we're going through right now. We thought that the impact of the interest rates was related to politics, but it has not anymore. So the interest rates here in the US, and because the dollar is the reserve currency, we're seeing that it's affecting the interest rates in Latin America as well. Specifically, the example of Colombia, like in the last few years, we were working on a 4 to 5% a year interest rate environment. It's now up to 14%, and it's moving with the interest rate in the US, opposed to moving with the political risk that has been the historic needle to the interest rates. My question would be, how do you think the interest rate is going to be evolving the next 3 years? Because that's definitely impacting everything that you're mentioning in terms of the performance of the companies.
Yeah, look, our view is that the structural bull market in fixed income ended in 2016. That's been how we played it the whole time. The exception obviously was COVID, which we were actually long fixed income, short bank, short high yield going into. But we actually believe there is we're in a structural bear market now in fixed income, which lasts the next 30 years. The demographics support higher yields. the reversal of globalization and all that has given us, essentially reversal of the peace dividend post the Cold War, is in itself an inflationary thing. We're fighting wars essentially on three fronts. We're fighting a kinetic war with Russia, a Cold War with China, and a climate change war. All of those demand huge amounts of government spending. Bank of England did some work going back 800 years looking at bond bear markets, and pretty much every single one was a function of a return to conflict that constrains trade, reduces productivity, and the other trigger was, by the way, a pandemic, and obviously we've just had one of those too. So we think we're in a very structural bear market. We think that fiscal rectitude on most sides of the pond has been taken out to the bike shed and shot through the forehead. Governments are prepared to spend. We're hearing some quite worrying things potentially about Biden's plan with the debt ceiling. If he cannot get this thing done, that he may just spend and allow the Supreme Court to try and judge this. The legal argument would be that politicians have already voted for the spending. So they voted through, for example, the Inflation Reduction Act, and that implicitly goes with spending. Hence, it negates the validity of the debt ceiling. If he does that, I'm very worried about the term risk premium built into the US Treasury market. So that's the kind of risk premium that you should earn for taking duration. That is still negative, by the way. The last time we saw that was the mid-60s, and then it rose over the next decade plus to 500 basis points into the highs of Volcker. So I think as things stack up, we are in a structurally bearish fixed income market. My suspicion is at some point that pain is going to get so great that the central banks are going to have to come in either with some sort of yield curve control or more QE, because that just will not be sustainable. But that's bad for the dollar, and that's bad for a lot of things.
Thanks, Julian. So I just have one more question. A lot of people are talking about the Chinese yuan and becoming a reserve currency, but I always thought it was impossible to become a reserve currency unless you run an account deficit. Can you talk about that?
That's absolutely true. I mean, that's absolutely, it's that simple, Marty. And the other thing is, I think, look, in the, we've clearly got a rejigging of the global playing field here, and as to how these packs end up splitting up. Multipolar world, sure, to some degree, but who in their right mind in a democratic country or in the West, so to speak, is going to want to hold, huge amounts of reserves in renminbi? Right? The answer is not many, right? Can it, that's why I'm not so Machiavellian about tin foil wearing when I talk about the demise of the dollar as the reserve currency. But I just think it's important to remember, even absent that, we saw a 50% collapse in the dollar post Plaza. Post Bretton Woods. We saw a 45% drop post Plaza. We saw a 38% drop post 2002, 2008. And the dollar is still here, right? It doesn't mean it just can't decline.